Okay, so today we will be analyzing Walmart's financial data. As we see over here, I used Yahoo Finance to see the quarterly breakdown of some of the statistics given. We got market capital in billions, which we see increased a good amount in the last year. Um, we have enterprise value, which also increased heavily in the last year. Um, trailing P slash E. I think that's price over equity. Um, so that went up, then it's been down gradually the last quarters, which is probably not good for the company. Forward price over expected has only gone up, and the PEG ratio over 5 years expected has also gone up. And we come down here, we can see profitability. Profit margin, 3% seems fairly low, but at the scale that Walmart's selling, I don't think that'll be much of an issue for them. Their operating margin's a little higher. The return on assets is 7%, which is actually very good. Or, sorry, revenue 700 billion. I don't think anyone can argue with that. Revenue being the money that comes in from any sale. Revenue per share. I'm pretty sure it's the revenue per share in stock, which is around 86 and a half. Gross profit 172 billion, which will be divvied out amongst a lot of people. Pretty big value. Uh, EBITDA, 42.88 billion. Earnings before interest and taxes. Yeah, then we have total cash on hand, which is only 9 billion in assets. Um, total debt 66 billion, but you need debt in the business to eventually make money, increase your revenue. So that's not too much of a problem. The debt to equity ratio 70%. It's pretty self-explanatory. And then the operating cash flow being 38. Um, that's more any cash flow within the company that has to do with, I guess, operating activities, which is like sales or things to do with the actual products and money inflows from the actual products. Um, a lot of shares outstanding, but yeah, pretty Walmart's doing pretty well overall. So now we'll come over here to my Gemini code. Um, so it's down here. Um, so for market capital, we see that market capital is um, formulated by current stock price multiplied by total number of outstanding shares. So there's a little breakdown on that. The enterprise value is the market capital then with that previous equation, plus the total debt, and then you subtract cash and cash equivalents, so some assets there. Then we go down to trailing PE. We see how that's formulated. Current stock price divided by earnings per share over the past 12 months. Forward PE is just current stock price divided by the estimated EPS over the next 12 months. So that's more the future. versus the past is trailing. And PE just means price divided by earnings. So yeah. And the PEG ratio is just price divided by earnings to growth. So it's just your PE ratio from before, um, divided by the annual EPS growth. We have P divided by S, which is price divided by sales, market capital divided by total revenue over the past 12 months. We have price book, which is market capital divided by book value. Then we have enterprise value divided by revenue, which is very self-explanatory. And then EV divided by EBITDA, which is just itself. And EBITDA is earnings before interest, taxes, depreciation, and amortization. If I didn't state that clearly before. So now we go down to the Python code. We have data collection. It collected all of my data from this portion. All this data here. Read data in the frame. That's just some random Python output. It's just reading the data. So then we're converting the date column to date time objects for proper sorting. That's kind of a sorting function. Set the date as index, and then we have df set index date, and this is another piece of coding. Yeah, I'll skip a couple of steps. That's just a lot of sorting stuff on Python's end. Then we have data analysis. This is kind of our, this is it, just printing the data from oldest to latest data. Showing me that with valuation growth and market capital, trailing PE, the overvaluation risk. It's saying the PG ratio is pretty high, so the stock may be kind of expensive relative to its growth prospects. So it's saying might not be the best investment. That's kind of what Python's telling me. And then we see that the forward PE is currently higher than the trailing PE, which can indicate expected earnings decline. So they expect to see a decline on earnings for the next however many next 4 quarters. Yeah. So we come down here and we're calculating the year-of-year percent change. And the way we do this is with these values, we just take the current period, subtract it by the prior period. Sorry. So like down here, we could take this value and, this value, subtract it by the prior period, and then divide it by this value to see what the percent change was there. Current period minus prior period, and then we divide that by prior period and multiply that by 1,000. That's how we find the year-to-year percent change. We could do that for trailing PE, price divided by sales, enterprise value. Yeah, they didn't exactly calculate it for me. Oh, they did up here. They did calculate it for me. Where was it? Here we go. Valuation growth. So the market grew from 551 billion to 850 in just 1 year. So that's pretty miraculous. That's a huge uptick. The PE ratio has increased from 29 to 38. The investors are now paying more for every dollar the company's past earnings. So not a great investment, although they are earning. Although Walmart has more capital, I think. Yeah, they have more market capital, but their investors are not too happy. Um, then the PG ratio is increasing, um, which can be a sign that a stock's overvalued. Sales and book value multiples, the price divided by sales and the price divided by book ratios have also steadily increased, which kind of shows that the stock price is growing more. Stock price is going up more than the company's, or I'd say on a linear scale, stock price is going up more, and they're getting more revenue, they have more market capital, but the stock price is still overvalued, so it's not a great investment. And I'm pretty sure we even see over here, yeah, they're down um a little bit. I don't, they seem to be doing okay, but a lot of the data is indicating it's maybe not the greatest investments. We see the exact percentages. Market capital increased by about 48%. Trading PE expanded by 31%. Price sales ratio grew by 40%, and then the enterprise value of it jumped up 32.2%. Um, and the enterprise value kind of just the jump highlights kind of that the company's enterprise value is growing more than its operational earnings, which also I don't think is a great sign for the company. So I would say Walmart is probably not the best investment. Um, but yeah, a lot of even with that, they're increasing market capital, pretty sure revenue. So some mixed signs from Walmart. But we'll see how their stock does in the years to come. So thank you.